Ed, thank you for coming to our studios again. We're looking at the earnings. U.S. stock futures rise on earnings, but euro snaps 5-day decline. We'll talk about the euro. But let's come to Wall Street. Is the party over for Wall Street, taking the earnings into consideration?
I don't think the party is over for Wall Street. Okay, we have something we've been speaking about called paradox of the bears, meaning the lower that bond yields go, the more attractive stocks look. Bond yields are at record lows all over the world, right? So it makes stocks look more attractive. Many stocks yield often twice what the 10-year Treasury here in the U.S. yields, and in fact are raising dividends. So the markets right now, what the equity market is reacting to is there's obviously a slowdown in China,
right,
and there is, of course, the ongoing Eurozone crisis, right? So the equity market is now beginning to get caught in that, right? Don't forget, it feels like a really bad year. We manage money for people. It feels terrible, but the S&P is still up, 7-8% year to date, even though it feels bad. It's actually so far a very good year. Now the equity market is waking up to what the bond market has been doing. The bond market has record low yields because of all the fear. However, money has to live someplace. And the lower that those yields go, the more attractive stocks look. So we do not think the party's over at all.
You were talking about the bond market, right? What was it? On Tuesday, around 8:29 a.m., it hit the record lows,
Yes.
10 years.
Yes.
What was it, 140?
Yeah, 140.
Can it go
right.
lower?
Yeah, absolutely. I mean, of course it can go lower. There's a great saying, right? That in other words, markets can remain irrational longer than you can remain solvent. So the momentum right now is for lower bond yields. People are afraid of Lehman Brothers coming again, of another Lehman type event coming out of Europe. But so far it has not happened. It doesn't mean that it can't happen. Another thing that we look at that I think viewers ought to pay attention to is the positioning of inside the stock market, meaning inside the stock market, you've seen all the defensive areas, food groups, utilities have been huge outperformers. So money has already positioned for a bad event inside the stock market.
That's right.
To the extent that you do not have this, to the extent that things, just do okay, you have a lot of room for the stock market to go higher. We also had late last night or late yesterday afternoon here in New York, a very credible rumor that the Fed is going to step in with more stimulus next week to try to boost.
Next week?
Yes.
As soon as next week. Who is that credible resource?
Well, it's from a station other than, it's from someone we won't talk about.
So we are expecting, taking the coming economic data that's been disappointing. Do you agree with that, Ed?
Well, there's no question that there is a slowdown going on globally. That is now, it's unfolding, it's there for everyone to see. But again, this is the paradox. As the economies slow, as interest rates go lower, as central banks add more stimulus, you have stocks that look attractive. In other words, they're still growing. They're just growing less. And they pay dividends. They're growing their dividends, and those dividends are often, here in the U.S., twice the 10-year Treasury. But if in cases like Austria or in Germany, and I think Turkey is benefiting from very low rates, those dividend yields are much, much more than what you can get on a Turkish bond or a German bond.
Good point. And I want to come back to the earnings right now, especially Apple, the technology sector. You talked about the momentum that is being lost in certain sectors and gained in others. How about the technology? How about Apple that came last night? Let's have a dive into the numbers from the earnings report after Apple misses estimates for on the second time since 2003. And a look ahead to what the iconic tech company has coming next. Is it iPhone 5, Ed?
Right. Well, we don't follow individual stocks,
Yes.
but I think Apple is instructive to the global, to the general investing environment. What Apple has two things going on. One is that it appears that they did have some pause in their sales because news is out that they're going to completely redesign the iPhone coming in October. So a lot of people are now beginning to wait for that next product. They did report slowing sales in the emerging markets in China, which is a little bit troubling. But going back to this issue of where does money go, Apple now yields. Apple now has a cash dividend of roughly 2%. Apple has no debt. And
sitting on cash.
Sitting on hundreds of billions of dollars of cash. okay, they are in better shape than most governments.
That's true.
So I think that as we go forward, why do I think that the party's not over for stocks?
Right.
Because I think investors could begin to look at stocks almost like the new bonds, where you can buy something like Apple that yields 2%, that has a lot of cash, that has no debt, okay, that is still doing tremendous sales. They're just slowing a little bit in certain parts. That investors, when they wake up to the fact that that's actually safer than owning a bond, that's when the stock market will begin to move higher.
But how about Facebook? How far Facebook has actually come since its ill-fated IPO? Where is the stock price compared to the first trades, as we remember, and its recent lows? Where do we stand with analysts' buy, sell, hold recommendations?
Right, right. I mean, again, we don't follow Facebook, but that's kind of new because it was an IPO.
Right.
I think Facebook obviously did the right thing for Facebook. They took a lot of money off the table. They didn't leave a lot for investors. But make no mistake, Facebook I don't think is important at all to the general direction of stock prices.
Good point. We talked about the euro, right, at the beginning of our conversation. Euro snapping with a 5-day decline. And the person who is heading Australia's central bank, Novotny, they say that euro is reacting to the command from Novotny. What did he say? Is that true?
Well, he's talking about perhaps a banking license or adding additional firepower to the European bailout fund. I think markets are sort of becoming immune to this. There's a lot of talk that constantly comes out of all of the various European ministers. I think the European politicians, obviously it's very different here in the U.S. In the U.S. we have a much more tighter command structure in the financial markets than in Europe. So there's a lot of different rumors. But the fact that investors have to take away, what investors have to look at is that the markets are scared of a Eurozone breakup. Right? Now, we haven't had the breakup. And in fact, when you look at all the actions that have occurred and all the talk, they're actually trying to fix it. And I think that investors need to start to think about what if they actually can come up with some sort of a plan that at least gets us through the next period. Markets are pricing, investors are pricing this sort of end of the world scenario.
That's right, the fear.
The fear is gripping everyone around the world, and you can see that in the bond market yields. In other words, the yields in bonds are telling you that people do not want to buy stocks, they'd rather own bonds at no yield.
But what do you say to your clients? Do you tell them stay away from financial sector, invest in the dividend-paying stocks, defensive versus cyclical? What do you tell them?
I'm glad that you asked that. We run a little bit of different process. We do something called accelerated time and capital. We actually break the long term ourselves into a series of short terms. So what our quantitative models are actually sensing is that in fact there is an inflation pulse coming back into the market. It's slowly beginning, and that we could see stock prices go higher as we go into the back half of the year. So we are at the moment holding mostly bonds, but we run a week-to-week model. So in our week-to-week model, we actually think that the long term has too much anxiety and too much uncertainty. It's much easier to do it in a very short series of periods.
The VIX going up 5% this week, right? Talking about week to week.
Right.
Do you see the fear?
Well, the VIX is actually much lower than it was, in 2008. The fear is in the bond market yields being so low around the world. And people talk about, well, it's the Fed manipulating. The Fed does not explain low rates in Turkey, in all over the world. If you're a strong country or you have a printing press, you have very low yields. If you're a weak country or you don't have a printing press like Spain, you have high yields. So the fear is in the bonds, and the fear is in the fact that you have, here in the U.S., it's very interesting, utility companies trade at a higher price earnings multiple than tech stocks. That is, unprecedented. You've only seen that maybe twice in recent memory.
Why so?
Well, normally tech stocks should be awarded a higher multiple because they have a lot of growth potential. Utilities do not have a lot of growth potential. But they do have safety because everyone needs electric. Everyone needs power.
Utilities like PSE&G.
That's right. Con Edison here in New York.
Companies.
Right. They are getting the market's awarding them a higher multiple than tech stocks. It's because even within the stock market, investors prefer safer places, perceived safer places, rather than growth. And I think that they're looking ultimately in the wrong places. They should be thinking more about that as we get past this crisis.
So if I sum a little bit about your strategies toward that you recommend to your clients, I see less bonds, more stocks. And can I tell you that you are more bullish in the equity market more than the bond market?
Yes, absolutely. I think that investors, bonds are not going to be an investment. Okay, with the 10-year Treasury at 1.4%, here in the U.S., our Fed is telling you that they're going to create inflation at 2%. Investors should not think of bonds as a long-term investment. They should be thinking about equities. Equities are inexpensive relative to bonds and relative to what the growth prospects are in the world.
Talking about interest rates, Ed, should the investors be worried about the housing sector? I mean, the prices have been going down, the mortgage rates are down, yet the supply and demand, they are still not balanced, and the housing sector is not where we wanted them to be. Is it because of the foreclosures that keep coming into the market? Where do you see the housing sector going?
If you believe that stock prices lead fundamentals, right? Something we always talk about with clients, and this is a very good something for investors to understand. You and I live in the world of the news of today. Stocks live in the world of what might be. They live in the world of what is coming.
Right.
And one of the best investments this year has been, here in the U.S., home building stocks. Those same home building stocks that were absolutely decimated and crushed in 2008, 2009. So here in the U.S., the home market, the housing market, seems to be bottoming. By bottoming, meaning that it's not going down. Where it's going down, the rate at which it's going down is slowing. And in some markets, it's actually starting to go up. And so the home building stocks have been one of the best investments so far this year, perhaps signaling that home prices are recovering. And it makes sense. Look, home prices are ultimately going to be tied to employment and interest rates.
That's right.
Employment here in the U.S., while it is not great, it's not getting that much worse. It's kind of slowly stumbling, getting slightly better. But every time interest rates click down, you can get now, I believe, 30-year mortgages at something like 3.5%, 3.75% here in the U.S. That makes a house very inexpensive.
And that wraps the end of our conversation. It's always lovely to have you at our studios. Thank you, Ed, for coming.
Thank you for having me.